Kumba is losing 120,000 tons of production daily from the strikes happening at its mine, scaring off investors further as the company tries to deal with wide-cut strikes across the country. Now, the attractiveness of South Africa's mining sector is under immense pressure and seems to be hitting a rock bottom at present. Kobus Nell, mining analyst from Stanlib, joining us now to answer the question of whether the mining age is coming to an end here in South Africa. That, of course, a very heavy question, Kobus. Let's first get your view on the resignation of Stuart Murray, because this man has been synonymous with Aquarius Platinum, and it seems that he just couldn't take the pressure anymore, and he decided, you know, that's enough, and it's not the only CEO that we've seen leaving the mining sector.
Yeah, no, that is casualties this year. Obviously, you know, Anglo-American, Impala and Lonman sort of lost their bosses this year. And, you know, it's a tough year. It's a tough time for all these guys, you know. And I guess Stuart was the sort of the pioneer, the first voice that really sort of spoke out on certain issues, you know. Some people
brave enough to do so.
100%. Some people even criticized him and said, how dare you do that or whatever. But at least he puts a lot of issues on the table. And looking back now on many of these issues, one would say maybe he had a point.
Mm-hmm. When you talk about, you know, the question of the mining age in South Africa, and why would someone put their money into the environment here in South Africa, or the kind of mining sector here in South Africa, when there is just so much instability and it seems a lack of clear leadership from government?
Well, I was saying to somebody today that uncertainty is the norm in world history, you know, so nothing's changed, you know. And maybe you could comment on this, Kobus, that, you know, if we're not getting the stuff out of the ground and selling it abroad, it ain't going anywhere, so it's still around. So at some point, the economics are going to fall into line. We still are the treasure trove of the world, so perhaps we shouldn't get too fixated on short-term issues that are fiery, but you know, that doesn't necessarily mean that South Africa's out of mining forever and a day.
Yeah, I mean, mining in emerging countries is normally risky. You know, you got to know when you invest in these companies, you know, it's not a nice Bitvest or you know, something that just goes smoothly always. You know, there is a lot of a risk you got to incorporate when you make your decision. But I guess importantly, you're right. I mean, ultimately the assets are still there, and I think that's why it's important to structurally not change the environment around these assets, i.e. when you get to a point, take the gold sector for instance, you know, they are sitting at the end of the global cost curve in terms of their operating cost. And if you're going to load another 20% or 15% or whatever on them for the next 2 years, you know, and you sort of move close to a normalized environment, you may not be in a position to profitably get these assets out of the ground and almost optimizing your asset value for all stakeholders, not just employees and shareholders, all stakeholders. And I think that is the essence at the moment. You know, the gold CEOs commented, and the Chamber of Mines as well. You know, they're obviously going to review now the wages, but they did say, you know, they did put the words in. It's got to be sustainable. You know, they got to still respect the previous agreement, because in the end of the day, if you've got an agreement and it's not honoured, there's no credibility, and it's no agreement. Why do you want to make another agreement? And what investor will ultimately invest in such a structure? Because there is just no tangible levels that I can really invest and trust on.
See, the thing is, what I want to understand is, if South Africa, as you say, has got the assets that are sitting in the ground, but we're not competitive with the likes of Australia or Canada, surely then those assets have no value anyway, right? And so then you have to write off the sector as a non-profitable sector that is deteriorating and finally.
But just on that point, they're having issues in Australia particularly, and that's going to still come to bite them. An insanely overvalued currency, very high labour costs. Okay, they've got mechanisation, but they don't have the same mining conditions.
And high taxes there. You're going to continue to tax the
but you don't have the same degree of underground mining that you actually have here. Australia's going to be an interesting one, because with iron ore and coal particularly, they're already skirting very close to the edge. And I think our treasure trove basket, as I call it, is perhaps a little wider than theirs. So it's not just us, I think.
Not if we continue in the path we're going. And I think that's where the problems come in.
Especially if you have marginal assets.
Yes.
You know, if you've got assets that sit in the bottom 25% of the global cost curve, it can sort of weather, you know, a couple of years of these above global inflation rates or whatever. Unfortunately, and we got to admit it, you know, our gold sector grades is falling each year, reserves are falling, it's getting more expensive to get it out of the ground. There's no question about it, you know. And in the end of the day, supply and demand, like we said, good old economics should prevail, But the problem is, in the interim, you can get volatility around it. And ultimately, I think for the good of everyone, you want to have sort of that perfect fit that will give as much as you can, as I said, to all stakeholders. You know, not just shareholders, and that is a risk. You know, when you invest in equities now in South Africa, you know, foreign investors will tell you that is a risk. They're worried how much of that share of that pie will be left over. You know. In the end of that.
And it's obviously, I mean, mining is always a long-term game and a long-term investment. Let's get back to the point that you made about the relative attractiveness of South Africa, because I remember looking at the Anglo-American presentation, and they have this whole map of the globe, and they talk about all the risks and all the issues that they face in the various economies, and you know, they've got these little symbols for political risk, government issues, taxation, labor unrest, and you looked at that map and you really did put South Africa into perspective. So what are your views on, you know, the issues, the areas, mining areas in the rest of the world that are perhaps comparative with what we're seeing in South Africa? Are there any?
Yeah, look, I mean, royalties, you know, the increases in royalties. We've seen that in West Africa, we've seen it in Southern America, you know, Australia as well. It's almost in every continent that actually mines, you see that, especially when times are tough as well, and that we got to remember. You know, when you sit where the government is looking for extra cash, its budget is not balancing, and people are struggling, they're feeling the pinch. You know, unemployment's rising. You know, one miner got to look after 8 dependents. That type of stuff. Then, you know, then people say, you know what, I'm not really getting along, and where can I get this? Where can I actually go and try and get this? And unfortunately, the mines in many, and almost all the countries, it sort of sits in that grey area. It belongs to the country, but then it also, in a way, belongs to shareholders because they've got a right to mine it. And you start getting, you know, on this sort of murky sort of water that I mean, that it can go anyway. And in the end of the day, you can have periods where one of those stakeholders in that pie is getting less than the other. But over time, that whole process should be managed in a way that, again, that you can optimize, really optimize the value of that asset.
Mining's always been risky. I mean, you've got, in the short term, you've got cash outflows, and your returns only come long term. And you can model it, but the real world is different from the spreadsheet. And so we actually play with the mining industry at our peril, because there's significant capital investment. There are assumptions that are made, return on invested equity, wherever it is, and then you upset the apple cart, and governments particularly should be very cautious of that.
But it's perhaps a good thing that you have the NUM, and then you have the Chamber of Mines, and I suppose the gold miners particularly coming out and having a joint statement that they want to resolve this in a way that, as you say, optimizes the output coming through, and basically creates a more transparent and smoother investment climate.
Yeah, you're 100% right. You know, and I think if you listen to the workers on the platinum front at this stage, you know, their biggest, I think, complaint, probably from a unionized perspective, is too concentrated. You know, the NUM has been perhaps too powerful. It's been seen maybe as the only one in the negotiation rooms, and I think they want to come out and say, as we know, you know, there's very little trust left at the moment on the platinum, in the platinum sector for the NUM, and they're looking for almost for a fresh breath that can come out and that they can trust, and they can say, you know what, we trust you to make sure that you will make sure that you will carry our best interest at first, not the other way around.
Okay, but in the meantime, we're of course, you know, looking at the market, resources on the front foot today. We saw a sharp sell-off last week. Any areas, specific stocks that are offering value right now because of what's happened? Yeah,
I mean, you know, the first one I guess one will look at is maybe some platinum shares. You know, I think Impala Platinum is sort of one that showed it sort of invests through the cycles. You know, and at the moment they are producing at these sort of much higher basket price levels. But ultimately, you know, again, you know, when you invest into these mines, you can go through volatile periods. You know, and I think at the moment we are in a margin contraction period. So we are moving in a period where cash flow is tighter, margins are falling, all these other things. But ultimately, you are buying the underlying assets.
What about Aquarius? It's like 6 rand now. I remember I think it got to 100 rand at one point. I mean, would you be buying Aquarius?
Look, it's not sort of one that screams to me. I think it's still speculative. You know, it's I guess, you know, coming down from the levels where it is, and sort of for it to jump from 3 rand to 6 rand doesn't take a lot, of all due respect.
What do you need to see from Aquarius before you put your money into it?
No, I mean, you know, I think you've got to see a stronger market, more indication that you're sitting more in a structurally bull market opposed to a potentially structurally, not necessarily a bear market, but a struggling market for longer, you know. In this kind of market environment, I would stick with the tier 1 assets, you know. The likes of Impala, maybe Northern if you want to go and try and extend, you know, that's a company that's going to bring more volume to the, and show that volume growth, which is good, you know, in an environment like this where you have a lot of producers that we will likely see production falling given a lack of investment. The guys that can be there in the end of the day, when the music really starts to play again, those will be the guys that will get the biggest benefit, I guess, out of this.
As you say, when the music starts to play again, but in the meantime it seems a little bit gloomy.